Hey guys, it's Carter. Welcome back to the channel. Hope you guys are all having a great and amazing day today. In today's video, we're going to be talking about Messi. Yes, Messi, the soccer player. We're going to be talking about his clothing brand company IPO'd the other day, and the stock went absolutely crazy, rallying over 200%. So we're going to be breaking out kind of what's going on with this company, and by the end of this video, you guys will learn, should you buy this stock. So I hope you guys all enjoy it. If you have any questions, let me know down in the comments. So let's jump into it. So for those of you that don't know really what's been going on, well, one, Messi owns a clothing brand company, and pretty much what he wanted to do and what this brand wanted to do is to IPO so the public can invest in him, his products, and into the companies. Anytime you have, a very, very popular person or popular company IPO, what you have is something called an IPO breakout. What tends to happen is you'll have a whole bunch of people that want to invest in him. And that's kind of what we've seen. The stock IPO'd for about $5 a share. It IPO'd, and within about 4 hours, the stock was trading at $16.61. Now, obviously, anytime a stock rallies that much, that quick, you're going to have sell-off. And that's kind of what we saw. Within a matter of, 3 to 4 hours, the stock was trading all the way back down to 9 to 10 bucks. And before you know it was trading back below the IPO level. So kind of why did this happen? Very simple. IPO breakouts happen, with very, very popular stocks and very popular companies. Just because a stock popped up, this does not change anything internally about the company. All this changes is the amount of investors that they had at that given time. Now, looking at this company as a whole, this is what the company is. It's MGO Global. Now, you'll notice the revenue here is $140,000. And this is a decrease here of 41%. Obviously, not a good sign, not a good start, but overall, still okay at best, right? Still bringing in some money. Now, the net profit margin, one of the most important things, at least that I always look at, is this net profit margin. This is how much money the company takes home at the end of the day after they pay their employees, after they, pay production and do everything. And this is their take home. So it's down 2,000%, and it's negative 447%. So what this means is for every $100 this company brings in, they actually lose about 443 bucks, which is terrible. It's very, very hard to grow a company in general. And let alone when you have these massive, terrible profit margins, it's not a good sign for the company internally. So, answering that question, should you buy this company? So for me, I definitely think that this company carries potential because anytime you have a celebrity of his size, it's going to be a company that is, talked about. It's going to be a company that's watched. It's going to have already so much advantage over other companies, and he wants to create, or in this company and brand wants to create a high performance clothing brand company. So I think that's awesome. I think it's great, but I just think the company as a whole is high risk, high reward. And I understand, you need to risk money to make money, but at what cost? Meaning, if you invest money in here, you possibly could be missing out on opportunity elsewhere with your investments. And so for me, I think that the best strategy, if you're gonna invest, would be to dollar cost average it. Invest weekly, monthly into this company. The reason why is because you can use the volatility to your advantage. These high growth, high volatile stocks, they're gonna move. They're gonna go up and down. So if you can time in, get in and out of positions with ease, I think that's a great approach. And dollar cost averaging, what you can do is anytime the stock sells off, double what you normally will put in, average down that share price. So when the stock bounces up, recovers, rallies, you can make some money. Now, the issue with that is the volatility. It's very, very hard to judge if a stock's undervalued, overvalued, and everything in between. So I think dollar cost averaging and keeping it under 1% of your portfolio size is key. The reason why is because if you want to invest, let's just say 10, let's just say you want to invest 10%. That is a lot of money added up over time and compounded on itself. And if this thing takes off, you have 1%, and you have shares, you can make money. If this thing tanks down, you're only out 1% of your portfolio size compared to 10% of your portfolio size. So that will take months, if not years, to recover that 10%. The 1%, not that big of a deal. And so I think that's the best approach, at least for me, is understanding these growth stocks, these high risk, high volatile stocks. They carry potential, they carry a ton of risk, and you just have to do your own research before you invest and understand the volatility, but the growth on the flip side as well. So I think that's the best mindset, the best approach with that. And am I going to buy it? Honestly, I'm not sure. Anytime a stock does an IPO, I always wait a week anyways before I invest. And the reason why is because these IPO breakouts can take a couple of days after an IPO, or a couple, in some cases I've seen it take a couple of weeks, and the stock just started going crazy for no reason, but they announced some sort of news and the company went crazy as well. So I just think wait a little bit. If you're a beginner, unsure, in some circumstances, it's better just sit on the sidelines and wait and see what happens than to hop in a company that you're not fully committed in and lose money. I think that's the best approach, guys. So I hope you guys enjoyed it. If you guys did, hit the like button, subscribe. If you have any questions, let me know down in the comments, and we'll see you guys later. Take care, everyone.